A conflict can flare up thousands of miles away, and almost overnight, stock markets all around the world just shudder. Suddenly, the cost of everything, from your morning coffee to filling up your car, feels, well, a lot less certain. This isn't some hypothetical classroom exercise. This is the global economy right now. And what connects those distant events directly to your daily life is a kind of hidden economic trigger that's just been pulled.
So how does that chain reaction actually work, right? How does one single event, so far away, manage to reach right into your wallet? Well, it's not just about politics, and it's not even just about the price of oil. It's really about a single, massive shock to the entire system. And it all starts with this one number.
So while most of the market has been really struggling this year, the global energy sector is up a staggering 41%. Now think about that. This isn't just one sector doing well, it's a massive shockwave that is repricing our entire economy in real time. And you got it, it's the very first domino to fall. What we're seeing is the textbook definition of a stagflationary setup. And to really understand what that means, and maybe more importantly, why it's so dangerous, we need to peel back all those layers of daily market news and look at the underlying economic machine. We're about to explore a really dangerous trap that central bankers were hoping they'd never have to face again.
Okay, so it all begins with what we can call the energy shockwave. In our modern economy, a localized event just doesn't stay local for long. So when a major conflict erupts in a critical region like the Middle East, the first, most immediate impact is on the energy that, well, powers everything.
And here's exactly how that chain reaction unfolds. A geopolitical conflict kicks off, and almost instantly, energy prices spike. That surge in fuel costs then makes it more expensive to ship goods, which disrupts supply chains that are, let's be honest, still pretty fragile from the last few years. All of this together reignites the one thing everyone fears most: inflation. And that brings us right to the core of the problem. That combination of events pushes the global economy towards something really, really problematic. It's a scenario that economists call the stagflation trap. So what exactly is stagflation? Well, to put it simply, it's the worst of both worlds for an economy. It's this toxic combination where economic growth just grinds to a halt or even shrinks, but prices for goods and services keep rising anyway. Think about it. Your salary isn't growing, but your rent and your groceries are definitely getting more expensive. It's a trap that is incredibly difficult to escape. This comparison really shows why it's such a dilemma. In a healthy economy, you get growth and stable prices. Great. In a typical recession, yeah, growth falls, but so do prices, which offers at least some relief. But in stagflation, growth falls while inflation rises. You get all the pain of a recession combined with the pain of rising costs. And look, this isn't just a theory. This is exactly what the data is telling us right now. All around the world, indicators of economic growth are flashing these bright warning signs. Just as that energy shock is pushing prices higher, we are literally seeing the stagflationary setup form in real time. Now, this dangerous mix puts the world's most powerful financial decision makers, we're talking about the central bankers at institutions like the Federal Reserve and the European Central Bank, it puts them in an almost impossible position. They're basically forced to fight a war on two fronts. If they choose to fight inflation by raising interest rates, they risk crushing an already slowing economy and triggering a really deep recession. But if they try to support growth by cutting rates, they risk pouring fuel on the fire and letting inflation run completely wild. There are just no easy choices here. And they know it. When the head of the European Central Bank, Christine Lagarde, says they need to be ready to act at any meeting, that's the language of high alert. That kind of phrasing signals that the situation is incredibly volatile and that the old playbook, it might not apply anymore. And this dilemma isn't just happening in a vacuum. It's a synchronized shock that's hitting every major economy all at once, creating a global domino effect. So let's take a quick look at how this is playing out, starting with the world's largest economy. Here in the US, the market is caught in that same tightening vice. On one side, you've got economic activity that's clearly softening. And on the other, rising energy prices are feeding those inflation fears, forcing everyone to question whether the Federal Reserve can even cut interest rates at all. And you can see this divergence playing out in the market itself. While the broad market, especially those tech-heavy growth stocks, is falling, the energy sector is surging. So the very source of the economic problem is the only part of the market that's performing well, and that is a classic sign of a stagflationary environment. Now, over in Europe, the situation is perhaps even more vulnerable. With its heavy reliance on imported energy, the price shock just hits harder there, and the economy was already showing signs of weakness. Europe is, for all intents and purposes, drifting towards stagnation. And we can see it in the data. The OECD just cut its growth forecast for the Eurozone pretty significantly. Business confidence in Germany, which is Europe's industrial engine, has dropped, and manufacturing activity all across the continent is weakening. Each of these is a bright red warning light flashing on the economic dashboard. Japan, meanwhile, is facing its own really unique balancing act. As a massive energy importer, higher oil prices are a direct hit. But at the same time, its currency, the yen, has been weakening, which just makes those already expensive energy imports even costlier. See, the Bank of Japan wants to carefully and gradually move away from its ultra-low interest rate policy. But the reality of the market is clashing with that goal. This external shock is forcing them into a corner. Tighten policy to defend the yen, but risk hurting an already fragile economy. The final piece of this global puzzle is China. Now, on the surface, its domestic economy has been showing some really strong signs of recovery. But even China's strength isn't immune to what's happening in the rest of the world. And this creates a fascinating contrast. Internally, industrial profits are up impressively, but externally, the global energy shock and renewed trade tensions are weighing on its stock market. It's a crystal clear sign that in today's world, no country can truly decouple from the global system. After seeing all of this, you might be tempted to think, okay, this is all just a reaction to a temporary spike in oil prices. Once that settles down, things will go back to normal. But, that would be missing the bigger picture. The real story here isn't just about one event or one falling domino. It's about a global economic system that has become incredibly fragile. Years of disruptions have left it with very little buffer, very little resilience. And now, even a single shock can send tremors through the entire structure. The system, well, it's lost its ability to absorb a punch. And that leaves us with the ultimate question facing investors, policymakers, and really all of us. Is what we're seeing just a temporary disruption that's going to fade in a few months? Or is this the beginning of a new, more difficult economic reality, a persistent stagflationary environment that could define the years ahead? The answer? Well, it's going to shape everything.